What's up, guys? Welcome to the Hamid Talks podcast, episode number 3. I hope you guys enjoyed the first 2 episodes. If you did, welcome back. If not, welcome to your first episode of the Hamid Talks podcast. In today's episode, we're going to be talking a bit more in detail about the different hours within the trading day. We're going to go a bit more in depth about market makers and different things like that. So today's episode should be a bit more interesting, right? So for the first 2 episodes, we were trying to give a base foundational understanding of the overall market, trying to give like a general overview of what trading is, investing is, long-term investing, what trading is, etc. So now we're going to get a bit more in detail. Okay, so basically what I want everyone to understand is that there are certain times in the market where it's more favorable to trade. So I want to piece things into 3 different sections. The first section is the early morning hours. So the market hours are from 9:30 a.m. to 4 p.m. The early morning hours would basically be around 9:30 to 11:30, right? 11:30 is when the London stock market closes. So essentially, the market starts to die off a bit after that time. Then the US market, most people have lunch. So that's why around 12, 1, 2 o'clock, the market is also a bit dry. It becomes a bit more stagnant. And then the final hour is known as power hour. That's when volatility picks back up. So there's 3 main sections. We primarily trade the first section, which is from 9:30 a.m. to 11:30. Essentially, the reason for that is because that is when there's a lot of volume and a lot of institutional power. There's a lot of volatility in the market. We're going to go a bit more in detail about what IV is in a different episode. But early on, early morning trading, lots of volatility, lots of movement. There's a lot of momentum. There's a lot of driving force momentum towards price action, okay? During the early morning. In the middle hours, that's when the market becomes the most choppy, right? Then the final hour, that's when volatility picks back up. It basically copies the initial hour and a half of the market. That's why it's known as power hour, because it's very, very volatile and fast paced. That is also when institutions come back into the market. That's when everyone is done having lunch and they're looking to close the day very, very strong, okay? So now that we basically understand that there's 3 main sections of the trading day, I want to talk about 4 very, very simple trades that you can make intraday, regardless of what time frame it is, whatever hour of the day it is, all right? So we are talking about basically buying, which is going long, and selling, which is going short, okay? So you could go long on 2 different occasions, okay? So number 1, essentially you could go long close to support and have a stop loss close below support. That's the first trade. You go long at support. You have a stop loss below support. That's the first trade. The second trade, you go long on a break of resistance. So as we get a 1 minute candle close above a level of resistance, you can also go long. Okay? So those are 2 very, very simple longing opportunity trades that you can take. Now we're going to talk about going short or buying puts, okay? So, which is also 2 trades. You could buy puts at resistance and have a stop loss a bit above that level of resistance. And the second trade with puts is you can buy alongside momentum, so that if we get a 1 minute close below a level of support, this is the 4th trade, a 1 minute close below a level of support, that's when you can enter into puts for follow through to the downside. So if we are entering calls with follow through to the upside, or if we're entering puts with follow through to the downside, those two specific trades work best during early morning trading as well as during power hour, because that is when the market is most volatile. That's when the market has the most volume and it has the most potential for momentum to follow through. All right. So now that we understand the 4 very, very simple trades you can make, you can carry those 4 trades on for literally for the rest of your life. You won't, if you just do those trades on the SPY, the NASDAQ, or the IWM, Apple, any of these large stocks, you're set for life, honestly, in my opinion. But this is not financial advice. Not your financial advisor. Anyway, so those are 4 very, very simple trades that you can make. And now I think, it makes more sense to talk about market makers, right? So we understand that, yes, we understand the various different hours of the market. We understand that the early morning hours are more volatile. We understand the power hour is more volatile. Cool. We understand all that now. Where do market makers fit into all this? So market making depends on what market we're trading. But for example, we can talk about options. It gets a bit complicated, but if you understand the option Greeks, you know that there are 4 main option Greeks that people look at. One of them is delta. Okay. So when we're going, say for example, we open up very, very simply. Don't get too complicated. It's not going to get too complicated here. Very, very simply, if you open up the options chain, you see, okay, SPY contract expiring this Friday. You buy whatever, call 370 call. To the left of that call, you can see the delta, the value delta of that call. You'll see the value is 50, for example. Basically, if I buy a call and that delta is 50, I'm expecting the contract to go up 50 cents for every dollar that the SPY moves up. Cool, right? Very, very simply. The market maker's job is to basically sell me that contract, right? So they're going negative 50. So their job as a market maker is to essentially try to get as close to 0 delta as possible. That might make no sense, but basically, if we're buying something with 50 delta, their job is they have to obviously sell that contract to us for negative 50 delta. But then what they end up doing is they buy as many shares of that stock as the delta of that contract. Okay? So essentially, if I'm buying a contract for 50 delta, they're selling it to us and they are buying 50 shares. So if the delta was 75, they're buying 75 shares. So essentially, they are hedging the option bet by buying shares. Okay? So it sounds very, very weird and complicated, but this is going on thousands of times a second, because this is going on for every single options contract, every single expiry, multiple different stocks, all at the same time. And it's not just one market maker. There are dozens of different market makers working on the same stock at different times. Some working on the bid, some working on the ask. It gets very, very complicated. But you have to understand that there are billions of dollars, trillions of dollars in the market. So they need to make sure that the market moves smoothly. All right, that's the market maker's job, for the market to move smoothly. They don't want someone with $10 million to come and just blindly click going long 0 DTE contracts on the SPY, right? If they did that, then basically what ends up happening to the person that buys $10 million worth of contracts is there isn't enough liquidity on the opposite end of that trade. Okay, so now liquidity is another thing. there isn't enough liquidity for large orders like that. So what they end up doing is that $10 million automatically loses 20 to 30% of its value, at least, on that execution, because there's not enough liquidity for the opposite side to enter and get a proper fill price. So this all sounds very, very weird and complicated. But what everyone watching really, really needs to understand is I highly, highly recommend you guys do some research about how this works, because there are people way younger than me, in their 20s, teenagers, that are basically at the moment right now, we can make a coin, a crypto coin. We can make a crypto coin called Joey, for example, right? We can make a Joey coin. We can pay someone to make a market making algorithm for us. All right. So we have control over the market for Joey coin. We are literally, so say for example, Joey coin trades on Coinbase, Binance, KuCoin, right? As market makers, as the owners of that coin, we literally have access to seeing every single order on KuCoin, on Binance. We can see, okay, someone bought this at $10 with $5 million, and they have a sell at $11.50. So what our job, what we can do is, obviously we want to provide liquidity for everyone that's trading on Joey, right? But then it becomes a lot more nasty, because on crypto exchanges, market makers are not regulated by the SEC. So essentially, what's going on at the moment on Binance, what's going on the other exchanges, essentially, right? Say, for example, a big crypto whale comes and he buys $10 million worth of Bitcoin spot. Spot meaning the coin itself, $10 million worth of Bitcoin. And literally, as soon as that happens, they are attempting to counter trade him. So they deliberately want to liquidate these larger players, because they don't want other people to profit on the market. And they want to, obviously they need to stabilize the market. But because crypto is an unregulated space, people are basically free to do whatever they want. They can liquidate people. They can create spoof orders on the order book to create sell volume and sell pressure when it's actually not even there. And that was actually something that caused an issue back in 2011, I believe. In the UK, it was known as the flash crash. So it was, I believe, an Indian guy in London who caused the flash crash on, I think, one of the pairs. I forgot what the pair was. I forgot exactly what he did. But that was essentially what he did. He created a bunch of spoof orders, which basically caused the algorithms to cascadingly sell everything. He made fake orders, essentially. People do that on a daily basis on the crypto markets. Literally, it happens all the time. And it's because it's not regulated. So I would recommend everyone get very, very acclimated with this stuff. It sounds super, super, how is this possible, blah, blah, blah. Literally, anyone can go and pay to make a market-making algorithm. The information and all this stuff is very readily available at the moment. And yeah, so I hope that sort of does some justice to that explanation. The other thing that I want to talk about is algorithms and where algorithms come into this as well. So what you need to understand is that there are thousands of different algorithms that various different funds are running. Say, for example, there's Fund X. There's an algorithm that tracks Fund Y. So people are able to see the orders that other firms are making. They have algorithms written based on the orders that other people are making. Based on the orders that other people are making, that algorithm readjusts the portfolio that firm X has. So there are, not only does firm X have in-house algorithms basically trading their own strategies, basically, okay, we're going to put certain weight based off of this move, etc., blah, 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 blah. They also have different strategies based off of other people's orders and moves as well. So at the most basic level, there's basically algorithms that do in fact track technical analysis indicators. They trade based off of indicators. There are algorithms that trade based off of 10K filings and earnings. Obviously, there's algorithms that trade based off of tweets. There's literally algorithms, billions of dollars worth of money that are literally traded on the crypto exchanges. For example, there are literally, when people tweet, right, there are algorithms automatically made to go short when specific people tweet. And that's basically what's going on in the overall market. But crypto is just, it's funny. But for the stock market itself, obviously because we can't really go short based off of someone tweeting, but there's algorithms for crossovers, shorter time frames. There's algorithms that basically, the reason why I enter and exit at certain points is because I understand that algorithms would be willing to load up on the positions that I'm also loading up in. And it takes some time to understand, but at the bare minimum, what we can all do is we can learn and understand where algorithms would be willing to enter. And essentially, you have to zoom out and not think like a retail trader. You have to try to figure out how to screw over retail traders. So you can't trade one-dimensionally. You have to zoom out and try to figure out what you would do to basically, if you zoomed out and you were a different person, how would I screw over this person that's trading? That's basically what you have to think. So essentially what they do is, one of the most simple things that they do is they try to run people's stops. So once again, if I have access, we can literally launch a coin this weekend. I have access to every single order that every single person makes on various different exchanges on Joey Coin. You don't think that they have access to every single little detail about everything that you're doing? They have access. They have all of the data. So it's very, very important to understand that, and basically understand that they have access to your stop losses as well. They try to force people out of their stop losses. And that brings me into the other topic, which is liquidity. Retail traders account for about 30 to 35% of liquidity currently in the market. And if you guys don't understand what dark pools are, basically dark pools are orders that don't show up on the lit market. So basically dark pools are orders that are not, they don't automatically affect the stock price itself. It's a way for institutions to basically trade outside of the overall market. Because say, for example, someone wanted to buy $200 million worth of Apple. If someone went and bought $200 million worth of Apple on the actual, like an exchange, say, for example, they just signed on to Robinhood and they tried to buy $200 million worth of Apple, they would get a very, very bad fill. It would mess up the market. It would just be bad. So orders like that happen on the dark pool. So retail traders, especially basically after 2016, is when retail traders began entering the market because of Robinhood. Robinhood introduced brokerage-free trading. Brokerage-free, trading. You basically trade for free. Before that, it was like you had to pay $10 per stock. Very, very bad. So as retail trading became more and more ubiquitous, as more and more people began trading, there was a lot more liquidity. Okay, so what I mean by liquidity is basically, we take a look at this. Take a look at this. It'll give a better understanding. So, cool. So we could just read this here. So, retail traders are unique in how they are handled in the U.S. Most retail orders are sold under, okay, so PFOF. Market makers buy the retail order flow, and they give these orders tiny fractions of a penny of price improvement over the best bid or the best offer. Essentially, if someone wants to dump 10 million shares, right? Market makers, the job of a market maker is they are working for that person that essentially wants to dump those shares. The only way to dump that amount of shares is if they get that amount of shares to be bought. So what they're going to do is paint a very beautiful picture over the course of a few minutes or a few seconds, even few minutes, few hours, to have someone else buy those shares. So what they do is they paint a very beautiful picture. Oh my God, look how beautifully bullish all of this look. Oh my God, oh, it's sitting up, but oh my God, it's gonna jump. Oh, boom, it drops. It's because that person wanted to dump those shares. So essentially, retail traders are used as liquidity. And at the moment, retail traders account for the same percentage as dark pools, basically 30 to 40%. That's how much retail trading volume is currently. And because the vast majority of retail traders have no idea how to trade, institutions take advantage of that. And they essentially use regular people as liquidity because they're very easily scared, essentially. They're very easily basically manipulated into fear, right? If you buy a stock at 100 and you have a stop loss at 99, they could drop the stock, within the minute, they could drop the stock to 97, have people sell at 97, rip it back up, and then rip it up to 105. By that point, people will end up buying. They'll try to buy at 105. Too late. The move already happened from 97 to 105. The stock drops from 105 to 102. And then that's what causes people to have whiplash, and people become dizzy. People become aggravated. They try to revenge trade. And it's tough, but it's very, very important to understand what the hell is happening under the hood. Try to figure out what's going on. So to basically summarize what I just talked about is retail traders are liquidity. It's very, very important to understand how market makers work. It's very, very important to understand that there are literally thousands of algorithms working in unison for certain things to happen, against certain things to happen. And it's all a data war at the end of the day. These firms are in competition with other firms. Certain firms don't want other firms to win. There are firms that counter trade each other, and is very, very prevalent in the crypto space as well. So in the crypto space, it's the most unregulated space at the moment. So if you do want to understand this stuff, if you do really want firsthand experience in this sort of stuff, I really recommend everyone enter the crypto space. Try to figure out what's going on over there. If you have money lying around, you guys can invest in trying to understand a market maker algorithm, and you can have someone make it for you. And literally, this could be a project being done over the weekend. You could make a coin, you could have a market maker algorithm, all that good stuff. So I would definitely recommend everyone do that. And we have a question. We have a few questions. Okay, so actually, before we talk about the questions, I just want to talk about then moving forward, what the easiest ways, basically longer term, we can make money with crypto, right? So when I first initially started learning about the stock market, I learned about Benjamin Graham and Warren Buffett. And what Benjamin Graham and what a lot of early investors did with the stock market was they found very cheap stocks and blindly threw money at various different stocks. Eventually, some of those stocks ended up winning and they got a return on those investments. So what I saw when I was basically a teenager was that the crypto market was a brand new stock market. So I didn't have to reinvent the wheel. I saw that Benjamin Graham, I saw that all of these other investors used this principle for a brand new market, which was the stock market at that time. And I just did it to the crypto market. And I threw a bunch of money into various different coins. And a lot of them worked out because it was the initial phase of the crypto market. So now, especially now that it's become more saturated, you're not going to get as big returns. But what I am waiting for, and if you have extra money lying around, you can easily throw money into various different cheaper coins that have a lot of upside potential. And that upside potential will far outperform any stock market returns that you'll ever make, because these coins will end up moving 50, 100x compared to a stock which might move 4 or 5x in your entire lifetime, right? So it doesn't compare. And what I soon realized as a teenager was that the older forms of investing just are not viable. People, that have wealth management funds and people that basically 401ks, for example, if you're just following the SPY ETF, people should not be happy about making 15% returns for a year. That's very, very bad in today's climate. Like, to make positive returns for the year, you basically have to be negligent with your money to make that sort of return on the year, right? But what basically these wealth management funds and what these other banks have done is they've marketed their inability to have a proper return, and then they just say, it's the market. The market is just very bad. The market just has terrible returns this year. What can we do? If the entire industry is saying that, obviously normal people, firefighters, teachers, people with 401ks, accountants, they don't understand. So obviously they're going to be like, okay, yeah, the stock market is doing pretty badly. All right, yeah, that makes sense why my portfolio is down 20% in the past 2 years. But no, none of that stuff makes any sense. It's very, very important for everyone to look into this stuff on their own, try to make sound decisions with all of the knowledge that's freely available at the moment. And definitely look into that. I would definitely look at various different cheaper coins that have a lot of upside potential. Throw some sort of money into them. If you have leftover money, a lot of that stuff can be very, very life-changing. So I would recommend doing that. The crypto market is still very, very relatively early, and there are only coins that are going to basically develop later on, and that haven't even been developed yet. So there's a lot of potential still left in the crypto space as well. So I would recommend everyone look into all that stuff that I was just talking about. Now let's go to our question. Do you have any long-term positions over 2 months out? If so, what are they? So currently I don't have any longer term positions over 2 months out. The reason for that is because, so essentially I do have longer term positions in crypto, but in terms of the stock market, I don't, but I'll talk about for crypto. So for crypto, I'm long Bitcoin, ETH, Solana, Litecoin, Mana, Atom, obviously a little bit of Link, SHIB, and Doge. That's really it. I have a little bit of Engine Coin as well, but those are the crypto coins that I'm primarily, not really like Doge and SHIB, but those are basically the coins that I'm long term. And the reason why I'm not really long any stocks, or it just doesn't really make sense to be super long any stocks. If you're going to be long in an asset, right? Most people, they just have like a badge of honor. It's like, oh yeah, I'm invested in the stock market. Yeah, I have a few stocks. What's the point of holding on to stocks if you have like hundreds of thousands of dollars as your retirement account? You don't understand, like you haven't really been following the stock market. You just newly started trying to figure out what's going on with the stock market. That's completely fine to be basically holding on to stocks long term. But if you're an individual investor and you don't have, this isn't your retirement account, this isn't your 401k, you deliberately deposited $100,000 into your trading account, for example, and you decided to put $60,000 into random stocks that you want to hold long term for years, what is the point of doing that? What do you want, dividends? I don't understand. Like, do you think that the market is going to go up? People have, in my opinion, what I've seen across the board is people have a misconception that sometimes that everyone should be invested in stocks, but sometimes it's inevitable that you're going to be losing money. So it's okay that the portfolio is down 15, 20%. It just comes with the territory. No, it doesn't come with the territory. There's no reason to be holding stocks long-term in a bear market when you know that the stocks are going to be going down. You could be making so much money with options playing to the downside. But the issue, right, it seems so obvious what I'm saying. But the issue is that people don't understand this stuff. So hopefully as this message gets shared with more and more people are going to understand the benefit of trading. People are going to understand the benefit of hedging their stock bets with options as well. Hopefully, knowledge will be more ubiquitous and more people will understand various different things. I have a lot of optimism for the space and people in general and where this is going to be going in the future. Very, very excited. But yeah, I hope you guys enjoyed today's video. I hope you guys enjoyed today's episode. Hamid Talks episode number 3. Take care. Thank you so much.